So just to start giving an idea of where we are. So as you know, in June, we ran our RAC ISA315 webinar series. And in week 1, we covered the general introduction and engagement and setup. Week 2, we looked at planning and risk identification. Week 3, not risk 3, was the risk assessment and planning of the audit programs. And then in week 4, we looked at execution and finalization. But as discussed during that time, we felt that we wanted to create some special time set aside for the schedule of uncorrected misstatements. So that's our bonus week 5 this week. And next week, we will take a deep dive into the estimates working papers as well. Just in terms of the timing of the first 4 weeks of that course, we just didn't feel we would do justice to these topics in the limited time that we had in those 4 weeks. These are 2 very important topics that we wanted to cover in a very, very practical way over the next 2 weeks.
Okay, so what you guys are seeing there is a quick workflow of RAC. I think you would be familiar with it by now. Now, the working paper that we are looking at today is our schedule of identified misstatements, or the schedule of uncorrected misstatements. Now, this is a very important working paper, and it gets impacted by quite a few other working papers in the audit approach. The first thing that comes to mind is materiality. Now, you will all know that materiality already starts here in the planning phase, where you determine your planning materiality. And in a lot of instances, that planning materiality is not necessarily revised. If it is revised, it will end up here, your revised materiality, and you will have your final materiality here in planning that will be used to evaluate the misstatements in the schedule of uncorrected, or in the schedule of uncorrected misstatements. The other very important part where it impacts, and Leon, we can maybe go to the next slide, is in the actual components where you are doing your work, you're performing your testing, and here you are finding the misstatements. Now, the misstatements can be limitation misstatements or disagreement misstatements. Those then are supposed to get transferred to our schedule of identified or uncorrected misstatements, where we determine if they are material individually or in aggregate, and how those misstatements will affect your audit report at the end of the day. Okay, so before we actually dive into the schedule of identified misstatements, we need to first understand and evaluate the misstatements that we actually find on the file. Now, I've put in here a few steps for you. Those steps are not on any working papers, so it might be a good idea to maybe just jot them down. These are quite important when you do your testing and you find a misstatement. So what do you do and what do you need to consider? So the first question that you need to ask yourself is, this misstatement that I found, to which financial year does it relate? Does it relate to the financial statements, the current year figures, or perhaps to the comparative figures, meaning that it is actually relating to a misstatement in the previous year? The next thing that you need to determine and ask yourself, as we've just done now, this misstatement, is it a limitation misstatement or a disagreement misstatement? Now, normally a limitation misstatement is if you could not get sufficient documents or the right documents to determine if a transaction is correctly recognized in the accounting records. A disagreement misstatement would be if you disagree with either the amount or the classification or even the timing of the transaction in which financial year it relates to. You know what it should be, so you can determine what is the accurate amount or period, and you are in a disagreement with what management has done. Then the next step is you need to determine the amount. Now, you would think if it's a disagreement misstatement, I just told you, you can determine what is the amount. However, remember when you do your testing, you can either do sampling or 100% testing. Now let's take the easy one, 100% testing. If you are testing 100% of the population and you find a misstatement, a disagreement misstatement, it's easy to ask management if they are prepared to fix that error. So you know what's the amount, they can easily fix it. If you are doing sampling, you need to look at the error and determine how does it affect or relate to the population. Because sampling, we are only testing a few items from the entire population. Is it an anomalous error? Now that would be an error that is not represented or is not representing the rest of the population. It is an error that happened once off. You've discussed it with management, it's a once-off error. That is an error that you do not want to extrapolate to the rest of the population. So you know what it is. It doesn't have an impact on the rest of the population. The next part is for all other errors that are not anomalous. You need to ask yourself, is that error or could that error take place in the rest of the population that you did not test? If the answer is yes, and in most instances when we deal with samplings, it could be yes, you need to extrapolate that misstatement that you find in the sample to the rest of the population. Now, what is important there is you need to extrapolate disagreements and limitations separately. The reason for that is when we get to the sum, I'm using sum for the schedule of uncorrected misstatements, your disagreement and limitation misstatements will be listed separately. For disagreements, you will know what is the debit and the credit, but for limitations, you won't know where the other leg is lying because you could not get the documentation to determine how that transaction should have been accounted for. Then, should you have journals in your sample, never extrapolate journals. The reason for that is journals are regarded very similar as anomalous transactions or errors. They do not usually reflect the rest of the population, so we do not extrapolate that. Then the fourth step. You might have been, for instance, auditing PPE, and you get a misstatement while auditing PPE, but you need to ask yourself, that misstatement, if it is a disagreement misstatement, what is the other component or line item on the financial statements that's also affected? And then the last step, if you communicate these misstatements to management, they may decide to do correction. Now, if it was 100% testing, management can easily do that correction, no problem. It does become tricky when you did your testing by means of a sample and you have extrapolated the amount. You need to go and have a look at what management have corrected. Did they correct the misstatement in your sample? or did they correct the actual population? So what is management supposed to do? If you communicate a misstatement to management in your sample, let's say 1 or 2 misstatements, disagreement misstatements, for instance, management is supposed to not just fix those 3. They're supposed to go back to the entire population and see if there are not any other transactions where they've made exactly the same mistake that we've picked up. So management could come back to us with a totally different amount that they want to correct than the amount that we've extrapolated or communicated to them. We will have to then select an additional sample of that population that they have corrected, exactly the same sample size as the previous sample that we selected, perform exactly the same test, and see if we do find misstatements again. If we don't find any misstatements again, we are satisfied that management's correction is acceptable and we can accept that, even if the amount was different from the amount that we communicated as the extrapolated misstatement. In the second sample, should we find the same misstatement again, it means that management have not corrected the entire population properly. We will fall back onto the extrapolated amount that needs to go to our overs and unders, or the schedule of uncorrected misstatements, minus the portion that management has corrected that we do agree with. Okay, let's go to the next slide, Leon. Okay, a few tips when you do your schedule of uncorrected misstatements. Do not wait till the end of the audit to complete this document. And I think this is the biggest misstatement or mistake that everybody is making. If you wait till the very end, the document is quite daunting, and you don't know where to put what. So it's very important that you start with this document even in planning, and I'll show you how it works, and hopefully then thereafter it would be a document that you are not afraid of and can easily complete. Something else that's important, if you have a disagreement misstatement, there must be a debit and a credit entry. If you only put in one side of the journal or the correcting journal, it would be out of balance, and the working paper will show you in red that you are out of balance and you need to put in the other leg of the transaction. Please remember, the debits and credits, we are putting that on the schedule of identified misstatements as the correcting journal. So what should be debited or credited to correct this misstatement? Then the last two portions here. If your misstatement is a limitation, on the sum there will never be another leg. If it's disclosures, there will also never be another leg. Okay, or another debit or credit if you want to think it like about that. Now, what we've done here is we've thought up a few misstatements, and we are going to take you to the schedule of identified misstatements, where we'll show you how to complete it. Now, this first misstatement that I've got here, we say it's cost of sale items were recorded at incorrect amounts, so it was understated. We were able to determine that it was a factual misstatement. We know exactly it was 20,790,000, it was a prior period error. Okay. We know exactly what's the amount. It was a disagreement. The correcting journal, cost of sales should have been debited and inventory credited. And now management, they did do a correction, a 20 million correction. Now, remember this transaction. Let's quickly go and see how it will look on our schedule of identified misstatements and how we need to document it. Now, I've color-coded this working paper a little bit to make it easier for us to go through it, and I'll quickly just explain the color code. So the very first sheet that we've got here is our list of misstatements. So the purpose of this sheet is to list all our misstatements, and it has 3 parts. Now, the first part deals with the prior year unadjusted misstatements. Now, if you've done your audit on Draftworx last year and you did a roll forward, then it would have rolled forward these prior year uncorrected misstatements automatically for you. But if that is not the case, and you are doing an audit for the first time, and you have prior year uncorrected misstatements on other methodology or other working papers, you will have to document them here. So the first one that we've just discussed is our cost of sales. It automatically pulled through for me. It's a disagreement misstatement. Therein, cost of sales is my debit leg that pulled through automatically. And if I come here to the statement of financial position, there you can see the credit leg in inventory pulled through. And I've got no message. Everything is in balance, debit and credit, and everything works great. Just before I go further, maybe I just need to explain some of the layout of the working paper. You'll see there is my statement of comprehensive income and my components or financial statement line items that deals with that. For purposes of this demonstration, I have hidden some of the columns that is where I didn't have misstatements, just so that it's easier for you to follow on the screen. So I have hidden a few, because for the statement of financial position, you would have seen that there are quite a few more components, but you don't see all of them. But on the top here, we are running the financial statement, so your disclosure notes and the components relating to disclosure notes, and we put journals here separately. Then you've got your statement of financial position, and here you've got your statement of comprehensive income and all the components that relate to those. The other parts of the working papers that you need to be familiar with is, first, you've got your prior year unadjusted misstatements. The disagreement misstatements and the limitation misstatements will pull through automatically from your prior year working paper. Then, a little bit lower in the working paper, you've got your current year misstatements. And just to make it easier for us, I've colored them orange. So you also see the tabs here at the bottom that I color coded. All of the tabs that are orange relate to current year. The green one relates to the prior year. And here, lastly, we've got misstatements that you identify in the current year, but that relates to the prior period. So as I said on the previous slide, this is all information that you need to determine before you can actually complete the document. Now, I've also said that this is a document that needs to be completed throughout the audit, even during planning. Now, the first part of planning actually happens here on our green portion. This is the prior year unadjusted misstatements that pulls through here. So when you are busy with your risk assessment procedures, it is important to understand the prior year misstatements, because those misstatements, if management have not properly corrected them, could be a risk for happening this year again, even material misstatements. So what we need to do, you make sure it pulled through correctly. That is the first step. And then you need to determine what has management done. Now, you've seen on the slide that we said management made a correction of 20 million. Where do we put that correction? You see the second sheet that we've got here, misstatement adjustments. So I go to the prior year, and there is that misstatement. It pulls through for us automatically the prior year misstatement, but we know that management only corrected 20 million. So I'm going to put in there 20 million. Okay, so on inventory, the other leg of the transaction, and then you see as soon as I press enter, the red message will go away. Okay, so the next prior year misstatement, expense vouchers could not be provided to the value of 150,000. We extrapolated that misstatement to 1503776. Prior year misstatement, that is pulling through automatically. And the other component was that needs to be debited was other expenses. And remember, it's a limitation. What happens with a limitation? There isn't another component. So if we go back to my working paper, there's the misstatement, pulls through to other expenses as a debit, but there's nothing else because it's a limitation. Okay. Management didn't make any corrections. So on this adjustment sheet, I am not going to select it here. And this is very important. If you do select it here and you put in that management made a 0 adjustment, it kind of causes problems in the rest of the working paper. So please make sure only select the misstatements here where management actually made corrections and we need to evaluate those corrections. Okay, that is the prior year, and you can do this portion while you are doing your planning so that you can understand what management has done and you can already form an opinion of whether you agree with that 20 million that they've put in. You can do some additional work to see if you agree with the 20 million, because there's a 790,000 adjustment that they did not make, and we'll deal with that a little bit later. Okay, when we get to the prior year evaluation tab, you can do that also. Here you will see what remains, the misstatements that has not been corrected. So for cost of sales, we've seen that 790 that has not been corrected. Now you need to work in the columns down. The first one is, was the prior year audit report modified for this financial statement item? And it definitely was. It was a qualification. Was the modification adequately adjusted or corrected. So this is now where you need to determine, do you agree with what management has done? I'm going to say we do not agree. Okay. Because we are very sure that that 790 should have been adjusted as well. Now, what happens here? Should the current year audit report be modified on the comparative figure? Now, the decision that we need to have a look at here is that amount that they have not adjusted. Is it equal to or larger than the materiality figure of 2 million? In this instance, it is below materiality. That is why we are not going to modify the current year audit report. If that figure, if management did not put in a 2 million correction, let's say, for instance, they made it 5 million correction. And you get to the evaluation tab, you will see that the uncorrected portion now is bigger than the materiality figure, and it tells you here that you need to modify the current year audit report on the comparative figure. The only time when you will not do that is if you say you are satisfied with the correction that management has done. So this portion that remains is not a concern for me anymore. And then you do not have to modify the audit report. Okay, I just quickly want to go back and fix that. And here, I just want to say that I am not satisfied. Okay. If we have a look at the remaining limitation misstatement, management has decided not to make any changes. So there, please do not go and select that specific transaction. It will be there, but don't select it. Otherwise, we get problems. So now we're going to start tackling current year misstatements. So these are typically the misstatements that you will be picking up when you are performing your testing. So the first one that we've got there is the related party transactions was not disclosed. It's a current year misstatement. We know which are those related parties, and we were able to determine the exact amount that should have been disclosed. Because it is a disclosure, there will not be another component or another leg, and it looks like management have decided that they do not want to make any correction. So if I go to my working paper, back to my list, so I need to go and list it. It's not a prior uncorrected misstatement. It is a current year. So it's not a limitation, it's a disagreement. Now, the next question that we need to answer here is it individually material or immaterial? Now, we know our materiality amount is 2 million, so that would be immaterial. And I need to go to my related party. There it is. Okay, and I'm not getting any red messages because it's a disclosure. Only one leg is required. We also determined that management is not going to make any corrections. So there's nothing that we need to complete on the sheet. So this misstatement, we're saying current year acquired motor vehicles have not been recorded in the asset register. So we've got a situation that they required these motor vehicles. It's not on the asset register. It is a current year misstatement. Okay. We were able to get the invoices or delivery notes, and we know what the amount is. So it's disagreement. We picked it up while we audited PPE. So our PPE needs to be debited. The other component affected is trade and other payables, which needs to be credited with 5 million. So I'm quickly going to go to do that first leg, and then we'll come back for the second part. So we have again a disagreement here on the list. Okay, 5 million, however, is definitely material. So I need to go and find my PPE. And my trade payables. I just quickly want to show you, remember we need to have a debit and a credit. If I put it in like that, there is my error message saying that I need a credit leg as well. And then that credit leg is gone. We also said that management has decided that they want to correct this misstatement. So I'm going to my misstatement, current year, disagreement. Not the related party, it is the motor vehicles. It tells me that it's material. It automatically pulls through the amounts, and management has corrected the full amount, so I'm satisfied. That is the end of it. Leon, if we can go back to the next, or the same slide, just the second portion. Okay, so there you can see we are now dealing with the depreciation of those motor vehicles. They were also not recorded. Current year, again a disagreement, but now the accounts that is affected would be my PPE, where my accumulated depreciation is part of it, and depreciation. And funny enough, management has decided not to make that adjustment. Normally, hopefully, management would have done it, but sometimes management do funny things, and we need to follow what management are actually doing and their actual journals. So if we go back to our screen, in my list, current year, I need to add that misstatement. It is immaterial. But now, my depreciation, no, and there you've got that. Okay, and remember, management has decided not to do a correction, so I'm not going to do anything there. This specific misstatement, we are saying trade payables was not recognized. It was an extrapolated error. Then the current year error, it was a disagreement. What needs to be credited is trade and other payables, and inventory is debited. Okay, so if I go back to my working paper, this one is again immaterial. The inventory is 1.5. And my payables tick, we are in balance, nothing is red. Okay, and for this, management has also decided not to do a correction, so nothing on the next sheet. Okay, employees could not be physically verified, and the amount was extrapolated to 2450. It's a current year error. It's actually a limitation because we couldn't verify the people. So you've got a occurrence issue. This would be a limitation. Is actually the account affected would be our employee costs. Okay, and it's a limitation. So I've got a limitation. And because it's a limitation, this one is material, we know that there's only one leg that is applicable. So it will be my payroll expenses. So we need to determine there whether it is going to be my debit or credit. And oh, sorry, I'm tapping on the wrong place. Okay. Now, at this point in time, let's say you are finished with your execution. We didn't find any misstatements in this year that relate to the prior year. So you will see that that sheet is empty. There's nothing to evaluate there further. We've already had a look at the prior year. Let's just quickly make sure that everything is complete. So for our prior year other expenses, management did not make any corrections, so that limitation is still there. Was the prior year audit report modified? No, it wasn't. Was it adequately adjusted? No, it wasn't. But because it is less than the materiality figure, it's not a modification in the audit report. The same here for our inventory. That was a modification because it was more than 20 million, but we were not satisfied, and also not a modification on our audit report. So this is the entire evaluation for the prior year misstatements. We see that we will not have to modify our audit report for the comparative figures. Let's go on now to the current year. Now, this sheet will only apply where management has made adjustments for the current year. But they've made an adjustment that is different from what our misstatement actually was. So let's have a look here on the adjustments. For the current year, we had that misstatement. management adjusted the full amount. So we can expect that there would be nothing on that sheet. Let's say management decided to rather adjust another amount, like that. Would be out of balance now, but just for interest sake, let's go and have a look. So the remaining misstatement, which they did not adjust, would be 500,000, and we can do the assessment here as well. So it's asking, based on the additional procedures, are the adjustment acceptable? So management would have went back to the population. They would have made adjustments. We will have selected an additional sample, tested it again. If we are satisfied with what management has done, we can say that, yes, it is acceptable. So we do not worry about that amount anymore. And then here at the bottom, we say, if it's yes, and it's not zero, we need to document the reasons why we are accepting it. So in an instance like this, we can say, that we didn't find any additional misstatements. Okay, I'm just going to delete this for now because that was just for illustrative purposes. So I go back to my misstatements. I'm going to make that 5 million again, which was the actual correction that management put through. Okay, so that sheet is empty. The next sheet is again dealing with our current year misstatements, but it is dealing only with the misstatements that we've indicated here that are material. So I expect only to see that misstatement on that sheet. Let's go and have a look. There it is. Tells me my materiality. What is the actual amount? Management hasn't corrected it. Then it asks us, document management reasons for not adjusting the misstatement. So in this instance, where we say employees could not be physically verified, for instance, management is going to perform a fraud investigation. I don't want to make specific adjustments now, and there you can put in your hyperlink to the audit report because it is a material misstatement and the audit report needs to be modified in terms of that. Now, our next sheet is the evaluation of the immaterial misstatements. So if we go back and have a look there, so these immaterial misstatements that was not corrected, we need to have a look if those immaterial misstatements is not or are not perhaps in aggregate material. So if we go there, it will tell us for the current year, all of my misstatements that was not corrected for disagreements first. Here is my statement of comprehensive income. There is, for the total statement, there's only R1 million that is not corrected. So that is not material. For my statement of financial position, you can see that there are 3 amounts, R1 million, 1.5 and 1.5, which needs to be considered. And on my disclosures, there is again only 1 amount which I can immediately see is not material. On the limitations, it's listed for you. Million here, same there and there. So now the next question is asking is the total immaterial unadjusted misstatement material? No, none of them are individually material. Is the total immaterial unadjusted misstatement qualitatively material in nature? Now, something that can help you is if you go back to 1020. In the beginning, we have determined which of these components are qualitatively material. So if I just go down here, see, so we have depreciation, DPE, that we said is qualitatively material. Let's remember that one. We don't have a misstatement for taxation. There's nothing. And here we've got related parties, which is also qualitatively material. Okay, nothing further. So if we go back, I now know that for depreciation, we said that is qualitatively material, and also for related parties. For the others, we know it's a no. Okay. If yes, provide a motivation for the qualitative materiality in nature. Now, you are welcome to document your motivation there, as well as there. Why it is qualitatively material? Because it's qualitatively material, I expect that my audit report should be modified with the depreciation amount and with the related parties. There you can put in your hyperlink and indicate the specific component that you want to put the qualification on. So in this instance, it will be depreciation, PPE, and related parties. Now, what is also important is keep in mind for these statements. We've said on the statement of comprehensive income, there was only 1 million. Statement of financial position, there are quite a few amounts. For disclosures, there was only 1 amount. Now, the next part that we need to evaluate is the in aggregate misstatements. Now, if I say in aggregate, how the working paper is working at this point in time, it is taking these 3 misstatements for the statement of financial position, and it determines the absolute value of that. Now, the absolute value means that we are not offsetting debits and credits. So the total misstatement for the financial statement of position would be 4 million. 1 million plus 1.5 plus 1.5 is 4 million. 4 million is bigger than the materiality amount. So we might have an additional qualification on the statement of financial position based on the remaining uncorrected misstatements. I just want to mention something. If it's your firm's policy that you do not use the absolute value, but rather the offset amount, like the 1 million, then it would mean that it will not be an additional qualification, but that needs to be determined by your firm and your firm's policies. If that is the case, please contact support. We will help you to change the working paper that it does not work on the absolute value, but that you can set off the values. Now, What I've discussed here is actually concluded on in the next sheet, which is called the aggregate assessment. So here you will see for the statement of comprehensive income, we said that the audit strategy appears to be appropriate, so there isn't an additional qualification on the aggregate of the uncorrected misstatements. However, on the statement of financial position, we are saying there is a material difference in the statement of financial position. Consider additional adjustments in order to reduce this or otherwise document whether material differences is disclosed in the financial statement. Now, if management want to avoid additional qualification on the aggregate of the immaterial misstatements on the statement of financial position, it means that they will have to make some more corrections. Let's have a look here. They will have to either make corrections here. So either they need to go and put through the depreciation charge that they've never accounted for, or they need to recognize the trade payables and the inventory. Now, if you're working on the absolute values, they will have to put this journal through, otherwise you will still sit with a qualification if they only put that through, because you need to get below 2 million, your materiality figure. So if I go back to that sheet, I can document my considerations there, where the management, for instance, put through an additional journal. If they've put through an additional journal, I need to go back to my misstatements. Let's say, for instance, they've decided to, They've decided to make that adjustment. Okay. So if I go back to my immaterial, can you see now for my statement of financial position, I put through that journal. Now it is not more than materiality anymore. If I go to my aggregate assessment, it will show you that it is not an additional qualification. Okay. Just some other considerations that we need to take into account before we finalize this working paper. Are there any of the unadjusted misstatements that is relating to fraud? I'm going to say yes, and it relates to the employees that we couldn't verify their physical existence. That could be fraud ghost employees, and I will need to put a hyperlink to my fraud working paper and document the details there. Then the next step that needs to be taken on this working paper is the communication with management and those charged with governance. It's very important that management are aware of exactly what the misstatements are. Hopefully they've corrected everything that they want to. Here we say, has the schedule of misstatements been discussed with management and those charged with governance, and to put in your hyperlink to the minutes or the management report. The next action is include a copy of the final schedule of misstatements to your management representation letter, so that management can sign off on the representation letter, full knowing what are the misstatements, and you can put in your reference here to your management representation letter. And then lastly, consideration for the audit report. Based on the above evaluation, indicate the type of opinion to be expressed. Now, there are a few places where you can pick up what the opinion should be. So firstly, let's go and have a look in my prior year, I can see none of the prior year misstatements are causing a qualification, so I can ignore that. We know that there was nothing on that sheet. There was nothing there. Material, here is a qualification. Okay? So it was a limitation. We need to make sure that that ends up in the audit report. Let's have a look on my immaterial items. We've decided that we know that we've got a qualification on PPE and on related parties, but both of these were disagreements. So we've got one limitation and two disagreements. So when we get to the final here, I'm going to say it is a qualified report. And I'm not saying it is a limitation because it is not pervasively limited. So it'd be my qualification. And then the last tab, and this is what is going to pull through to next year's schedule of identified misstatements. All of the amounts that you are seeing here are the amounts that have not been corrected. So they will pull through automatically to next year's schedule, and they will go and lie here on your misstatement list in the prior year, all of them here. Okay. So you can see this is quite a complicated process. You really need to keep your ducks in a row. Make sure that you've got all the information necessary for each and every one of these misstatements. And I think if you start implementing it, that you complete this working paper as you go along and as you do the audit, it would not be that overwhelming, and it would actually help you quite a bit when you get to completing your audit report in knowing what your audit opinion should be. Okay, the first one. What happens if I have a misstatement on completeness of assets where I don't have an amount? How do I document that on the working paper? Very good question. Completeness is sometimes a bit of a problem because how do you extrapolate? You don't have an amount. It might be that you need to qualify the entire balance on completeness. Okay, so it is kind of difficult. You don't know what is the extent of completeness. You've picked up this completeness in a sample. It could be that half of the assets are not on the asset register, or there's assets with very high values that's not on the asset register. So in an instance like this, I will qualify on completeness on the entire balance, and I will not try to put a specific amount to the misstatement, but rather the entire balance. Okay, if we move on to the next question. For the employees that could not be verified, is the misstatement value based on the salaries that were paid to those employees? So for this specific example, yes, but you will have to go and maybe just look a little bit further. There could be some other benefits that was always also attributed to them. Just make sure that you identify all the misstatements for any amounts that relate to this employees. But yeah, our example was based on the salary specifically.
So I'm hoping you've seen through today's presentation that there are actually a lot of places that can lead to a requirement for a qualification. it's not just one last little step at the end to say, okay, can I qualify or not? There are actually a lot of places where a qualification could come from, and to please be aware of those. And I think some of the examples that we use today might be instances that you don't really encounter on a day-to-day basis in your audits, like management only wanting to process a portion of a journal. My hope is that that's not necessarily always a thing you're going to battle with management about, but we had to build the template able to facilitate that if that circumstance arises. So there are one or two things we are going to be trialing on our end over the next few weeks and months, just to see if there's one more step we can use to alleviate. But yeah, we're hoping now the video will help to a large extent to help you to get where you need to be on this working paper overall. Now, I'm not sure if any of you have noticed it. We have built a feature into Draftworx that allows you to link journal entries to a working paper. Unfortunately, though, that isn't something feasible for us. So as Dillian pointed out, you will need to go and capture the details of the journal in O210 for each audit journal that is raised, whether or not it's adjusted by management. So please do this, but I think get into the habit of doing this as each journal is identified, rather than waiting for the end of the audit, because then the risk is that you might miss the transfer of some of this information. And so just do be aware as you're going through, try and keep this O210 document up to date. Don't wait till the end of the audit, because then it is going to feel a little overwhelming. Hopefully some of those decisions about what management adjusts are already made as you're raising the journal. Maybe they're already saying, oh yeah, okay, we'll process this journal. But I think what is very important is, of course, that it's always management's decision. That's the reality we do need to keep in mind at all times.